Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The strong stock market rally has surprised many investors and stock market strategists, with almost no one calling for the market to get back to flat for the year so quickly. And there are still several storm clouds out there. Joining me to discuss two asset classes that may weather that storm is David Grumhaus. He's the co-CEO of Duff and Phelps Investment Management. David, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Very glad to be here this afternoon.
What factors are you keeping in check that could derail some of the progress the stock market has made?
Certainly the major one obviously has to be COVID. Obviously, we're keeping a close eye on the cases in the Sun Belt. We're also watching to see whether cases reemerge, a second wave in some of the places where COVID seems to be under control. Finally, obviously, keeping a close eye on what's going on with the vaccine. Ultimately, I think what happens with COVID is going to affect what happens with the economy, and that ultimately is going to dictate where the market's going to go. I think the second factor is the U.S. elections. Obviously, they're coming up quickly here in November. Biden seems like he's in pretty good control right now, and I think the market is even starting to price in the fact that we might see a Democratic sweep, and that clearly would have implications from the overall market. Finally, we're just keeping an eye on U.S. and China relations. Obviously, there have been a lot of barbs being traded there, the situation in Hong Kong. And I think beyond that, just geopolitics in general, we do think that you could see escalations in front of the election in November.
So what's a good place to be for the second half of 2020?
So with Duff and Phelps, our big focus is on real assets, in particular global real estate and global listed infrastructure. And we think both of these set up well for the second half. Both of these sectors did not perform that well in the first half. Both struggled somewhat, and that was really due to some of the subsectors within those sectors that didn't do very well. So we like the setup going in. I think both sectors have attractive dividend yields, which is important in a low interest rate environment. We like the global diversification that both offer, and we also think both are pretty well insulated from what goes on with the U.S. elections.
Listed real estate did not display its normal defensive characteristics in the first half, as you had mentioned. What was the impact to REITs?
Yeah, REITs definitely struggled, whether you look at the U.S. or globally. Both indexes were down about 20% year to date. And I think that was really due, again, to a couple of subsectors and the headlines and performance around those subsectors, primarily retail, lodging, but I would also say healthcare and urban office. So those areas definitely, brought the index down. Having said that, the tail can't wag the dog here. It's really important that the REIT sector has really changed. These aren't our parents' REITs. Retail and lodging right now only make up 10% of the U.S. index and 15% of the global index. There are 11 other subsectors out there, and some of those, and many of those have traded really well and even benefited from what's going on with shelter in place. So I think it's important to remember that a lot of that sector is really doing well. Think things like data centers and cell towers and single family homes. So areas like that which look very vibrant. Additionally, I would say about REITs is right now they're trading at a meaningful discount to private net asset value. And that's been a strong indicator in the past of future performance. That discount is narrowed probably in half from the 25% discount that we saw at the bottom. But we still think they have room to run as historically over the last 25 years. Public REITs have really traded in line with private net asset values, and we're still at a 10 to 15% discount.
Why is global listed infrastructure a good cyclical play?
It's similar to REITs, I think. You've got a situation where a lot of the sectors have held up well, but you have a couple of sectors in there that have been unusually beaten up by COVID-19 and the pandemic and the shelter in place. We think right now the sector offers very good protection, but also good cyclical upside to a recovery. You got to remember 50% of this sector is utilities. And utilities have traded okay. They're down, sort of 10% year to date, but they probably should have traded better. They don't have a lot of impact from COVID-19. They're really benefiting from the higher investment that's going into them, the higher investment around renewables and clean energy. I think people forget that utilities are a really good way to play clean energy. Additionally, you've seen relative PEs on the sector go from sort of in the U.S. from maybe 1.25 times the premium to the S&P 500 to a sort of a 0.9 discount right now. Lastly, back to the elections, we think the utilities are really well insulated. They're one of the few sectors that won't be affected by higher tax rates because they essentially get a pass-through on that. And then also, assuming that the Democrats win and you get a Democratic sweep, the inevitable clean energy push will certainly benefit the utilities. I think when you look at other sectors in global listed infrastructure, you've got the communication stocks. These led by the cell towers, these stocks are doing great. Certainly, the higher bandwidth required from work from home is helping out these stocks a lot. Then you've got the two remaining sectors, which are transportation and midstream energy. And those are the sectors that have struggled. But we think a lot of bad has been priced into those. And we do think you will get some real cyclical upside if we see an economic recovery.
All right, David, thanks so much for joining us on Trade Talks.
Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.